Okay, Chapter 8 exercises. So again, the presumption here is that you have listened to the Chapter 8 lecture first. If you have not done that, I would recommend that you do that first, and then you come back and work your way through this one. All right, exercise 8.1. So Rizzo Company purchased a machine for $12,500, terms 210 net 60 FOB shipping point. They paid $360 for freight. Adding to the invoice, bringing its total to $12,860. The machine requires special mounting and connections for $895. Another $475 is paid to assemble the machine. In moving the machine to its steel mounting, $180 worth of damages incurred. Materials costing $40 are used to adjust the machine to produce satisfactory product. The adjustments are normal for this machine and are not a result of the damages. So they want us to compute the cost of the machine. So we're going to include our total invoice price, $12,500. We're also going to include the cash discount of $250. So we have a net purchase of $2,250. It is FOB shipping point, meaning it's the buyer's responsibility to pay for it while it's in shipping. So we're going to pay for those costs, $360. The mounting costs of $895. The assembly cost of $475. The normal adjustments of $40. For a total cost of $14,020. The only charges that are not included are that $180 worth of damages. Okay? All right. Why don't you take a minute and see if you can compute the cost of the machine in this problem. Same exact as the last one, just some different numbers. All right, so invoice price of $10,500. We're assuming, or they tell us that they paid for it within the discount period, so we're going to include the discount. We're going to include all of the costs listed above except for that $180 worth of damages. So we have a total machine cost of $11,740. Okay, hopefully you did well on that one. Moving on to exercise 8.2. So Kayla Manufacturing purchased a lot on which an old building is located as part of its plans to build a new plant. So they negotiated the purchase price for $280,000 for the lot plus $110,000 for the old building. They intend to tear down the old building and fill some of the lot in. So the costs to do that are $33,500 and $47,000. It also pays $1.54 million in construction costs, and this consists of $1.452,200 for the new building and $87,800 for the lighting and paving of the parking area next to the building. So prepare the journal entry to record the costs incurred, all of which are paid in cash. All right, well, the land improvements, the building, and what else did we buy? I think that's it. So our land are going to be the cost of the land itself, which is the $280,000, plus the $110,000 that they're going to knock down, plus the cost to tear down the old building, plus filling the land back in after they tear down the building. Okay, so all of that becomes land cost. Then we're going to have land improvements of $87,800. So that's for the lighting and paving of the parking area. And we have our building cost of $1,452,200. So we're going to debit all of those accounts to increase them, their assets, and our credit to cash for the total of $2,010,500. Okay. All right. So same problem, different numbers. Why don't you try to prepare the journal entry here, and when you're finished, you can resume the recording and we can go through it. All right, so let's see here. So they've got the negotiated purchase price of $281 plus $186 for the old building. So our land costs are going to be the total of 291 plus the 186 plus the cost to tear down the old building of 40,200 plus the cost to fill in the land after they've torn down the building. So we have a total of 576,626 there. Our land improvements are 101,035 for our parking lot and our lighting. And we've got $1,600,600 for our building. And our total cash, $2,278,261. All right, exercise 8.3. Rodriguez Company pays $375,280 for real estate plus $20,100 in closing costs. The appraisal of the land was $157,040. The appraisal of the land improvements was $58,890, and the building appraised at $176,600. So we have to allocate the total cost among the three purchased assets, right? So our appraised values for lands, $157,040. For land improvements, $58,890. And building, $176,670. So they gave us all those appraised values in the problem, right? So we have a total appraised value of $392,600. We paid, well, okay, hold on. Let's back up. So if we take each as a percentage of the total, the land ends up being 40, land improvements 15%, and building 45%. So then if you take each of those percentages times the $395,380, which is the $375,280 for the real estate, plus the $20,100 for the closing costs. Take that total times each of the appraised value percentages, and your portion cost becomes this. Okay? So now if we record our journal entry for the purchase, we're going to debit lands for $158,152, debit land improvements for $59,307, debit building for $177,921, and credit cash. Okay? All right, same problem, different numbers. Why don't you take a stab at it, and then we can go through the answers. All right, so our appraised values are 184,800, 79,200, and 176. They're all up in the problem. Take each as a percentage of 440. So 184,800 divided by 440 is 42%. 79,200 divided by 440 is 18. 176 divided by 440 is 40%. Take each of those values times the total cost, which is going to be your $380,000 for the real estate, plus your closing costs. You should have a portion cost as shown there. And if we do our journal entry, debit land for the apportioned cost, debit land improvements, debit building, and credit cash. All right. All right, exercise 8.4. Ramirez Company installed computerized manufacturing machine at the beginning of the year. The cost was $43,500. Has an estimated useful life of 10 years or 385,000 units with a $5,000 salvage value. During its second year, it produces 32,500 units of product. So let's first compute, hold on, let me erase those. All right, so the first thing it wants us to do is compute the second year depreciation under the straight line method. So here we take our cost of 43,000 minus 5,000 salvage divided by 10 years. So that's $38,500. So under the straight line method, its second year of depreciation is going to be $3,850. So in year one, we have a book value of $43,500, less annual depreciation of $38,500 or $38,50, ending value of $39,650. In year two, same depreciation, right? That's what the problem is asking for. Year-end book value of $35,800. And if we keep going for all 10 years, we have a total of $38,500 of depreciation, right? So what remains is our $5,000 salvage value. But what they're asking us is that yellow highlighted number. What is the depreciation in the second year? Okay. So now this is the same problem, but they are asking you to determine the second year depreciation under the straight line method as well, just using different numbers. So why don't you take a try at it? And then when you're finished, you can resume the recording and we can go through the answers. All right, so straight line depreciation is cost minus salvage divided by useful life. In this case, we have cost of $85,600 divided by a salvage value of $12,100 and 10-year life. So we have $73,500 divided by 10 years, or $7,350 of depreciation expense per year. So year one, we have a beginning book value of $85,600 less $73,550 depreciation, ending value of $78,250, $85,600 minus $73,550, right? Year two, we have a beginning book value of $78,250 less annual depreciation of $7,350, which is what the problem's asking you for a net book value of $70,900. Year three, year four, year 5, 6, 7, 8, 9, and 10. Total depreciation of $73,350. Total salvage value of $12,100 at the end. And you're done. Okay. All right, exercise 8.5. So here it's the same problem that we went through, but they're asking us to compute the depreciation using the units of production method. Okay, so the numbers we care about now are still this cost and this salvage and this 10 years, but we care about the units instead of, oh, I'm sorry, we don't care about the 10 years. We care about the units produced instead. Okay, so units of production depreciation is cost minus salvage, and instead of divided by useful life, it's divided by the total units, right? So we have 43,500 minus 5 divided by 385,000 units. So that's 38,500 divided by 385,000 units. So we have depreciation expense of 10 cents per unit. So in year two, you take your units produced of 32,500 times your 10 cents. We have $3,250 of depreciation in year two. Okay. All right, why don't you give it a shot? Units production, using the same numbers as the previous one you solved, I believe, but different than the one we just went through. All right, so under units of production, cost minus salvage divided by number of units to be produced. 85,600 cost less 12,100 salvage value divided by 274,000 units, they tell us right here, equals 27 cents per unit times 26,100 units that they are going to produce in year two. Total depreciation expense for year two, $7,047. All right, exercise 8.6. Ramirez Company installs the same machinery, but this time they're using the double declining balance method. And so I think we have the same cost in salvage, but the double declining balance rate is 200%, right? 200% divided by 10 years times the beginning of the year book value is your depreciation expense. So we have depreciation expense per year of 20% times each of the beginning book values. The other way that you could do it is the double declining rate would be 100% divided by 10. 100, oh, hold on. That's my highlighter. I need my pen. I think I'm going to use, how about purple? So I'm sick of red. Okay, so 100% divided by the number of years of useful life. This is going to be 10% per year, right? Well, if you times that by 2, the double declining rate is 20%. So 200% divided by 10 years, or 20% times each year, right? You get to the same answer. So the beginning book value is $43,500. Our depreciation rate's 20%. So our annual depreciation for the first year is going to be $43,500 times 20%, or $8,700. So $43,500 minus $8,700 is a year-end book value of $34,800. Take that $34,800 times 20%, and you get $6,960 for your year 2 depreciation, which is what they're asking for, but then they go on to complete the table. Okay. So in the last year, 20% of the $5,838 is greater than, it will take our net book value to something less than what it should be according to what they tell us the salvage value is, so it's a plug. So we're going to force the rate for the last year, and it's going to be $838 because we started at this 5,838 was our beginning of year 10 book value. So to get to 5,000, we just need to record 838,000 of depreciation in the last year. Okay. So we have total depreciation expense of $38,500, which is what we should have, and we have a salvage value of 5 when it's all said and done. All right, so why don't you give a shot here at this double declining balance method. When you're finished, you can resume the recording and we'll go through it. All right, so our depreciation rate is 200% divided by 10 years times the beginning of the year book value is going to be our depreciation expense each year, 20%, right? Or you can take the single rate. So if you take 100% divided by 10 years, that's 10% per year. Double it, it's 20. That's your yearly depreciation times your beginning book value, okay? So year 1, starting with a cost of $85,600 in this case, times 20% depreciation rate, equals $17,120 of annual depreciation. $85,600 minus $17,120, net book value of $68,480 at the end of year 1. That becomes your beginning book value for year 2 times 20%, $13,696, and then we'll continue to populate the table. So $68,480 minus $13,696 is $54,784. That becomes our beginning book value for year 3 times 20%, and so on. Okay. Then we get to year 10. We can't depreciate the entire balance because we'll go below the salvage value. So we're going to force it. So we're going to book $2,261. Oh, that actually happens in year 9. Excuse me, that happens in year 9. So that in year 10, we don't have any depreciation. Okay? So at whatever point you reach or you're going to exceed that net book value, or the salvage value, I'm sorry, you just plug the number to make it to take the book value down to the salvage value and then no lower. Okay? All right, so hopefully you did well on that one. Let's move on to the next. All right, exercise 8-7. So in early January, Tech purchased computer equipment for $154,000 to use in its operating activities for the next 4 years. It estimates the equipment's salvage value to be $25,000. So they want us to prepare a table showing depreciation and book value for each of the 4 years, assuming straight line depreciation. So cost minus salvage divided by useful life, 154 minus 25 divided by 4 years. It's 129,000 per year. Or I'm sorry, 129,000 divided by 4. 32,250 per year. So beginning book values are cost 154,000 minus our annual depreciation of 32,250 equals 121,750 at the end of year 1. Year 2, we have 121,750 minus our annual depreciation for a total of 89,500. Next year, we start at 89,500 minus our annual depreciation for an ending value of 57,250. 2021, we start with 57,250 minus 32,250. Our year-end book value of 25,000. Okay, which is what it should be. That's our salvage value. So it's your beginning book value minus your annual depreciation equals your year-end net value, or year-end book value, I mean. Okay? All right. Total depreciation of 129,000 over the entire life, which is what we want it to be. All right, so same problem, different numbers. Why don't you take a stab at it, and you know the drill. When you're done and or you are stuck, resume the recording and we can go through the answer. All right, so New Tech purchases equipment for 169,000 minus 34,000 equals divided by 4. Sure depreciation expense. So you have 135,000 divided by 4. Depreciation expense of 33,750 per year. So if we show it in table format, we have a cost of 169 less 33,750 of annual depreciation equals end of year value of 135,250. Year 2, we start at 135,250. Annual depreciation of 33,750. Ending value of 101,500. 2020, we have a value of 101,500 minus annual depreciation of 33,750 equals a year-end book value of 67,750. And then in the last year, we start at 67,750 minus 33,750 of annual depreciation for a net ending value of 34,000, which is what it should be because that's our salvage value, right? So we have total depreciation of 135, cost of 169, salvage value of 34. So hopefully you did well on that one. Let's move on to the next. All right, 8-8. In early January, New Tech purchased equipment for 154. Its estimated salvage value is 25,000. They want us to do the same thing we just did, but using the double declining balance method. So we've got either you can take 200% divided by the life, or you can take 100% divided by the life times 2. You get to the same answer. So 200% divided by 4 years means that we are going to book 50% of the beginning book value and depreciation every year. So in 2087, I'm not really sure where they came up with that year. I think they mean 18. We have a cost of 154,000 times our rate of 50% equals annual depreciation of 77,000. So 154 minus 77,000 is 77,000, right? Then in 2019, we have a beginning value of 77,000 times 50% is 38,500. So 77 minus 38,500 is 38,500. Then in year 3, we start at 38,500 times 50%, but the problem is 50% will get us to a number less than what we want our salvage value to be. So we just plug it, right? So 38,500 minus 25,000 means that we have to record $13,500 of depreciation in year 3. And then in year 4, we're not going to record anything. Okay? So we have total annual depreciation of 129,000, total cost of 154, total salvage value of 25. All right, your turn. Do the same thing, double declining balance, and when you're finished, you can resume the recording and we will go through the answers. All right, so double declining balance, you can take 200% divided by the number of years, that'll be your rate per year, or you can take 100% divided by the number of years times 2, it will get you the same answer. So we're going to depreciate 50% of our beginning balance each year, starting with the cost 169,000 times 50% depreciation rate. So our annual depreciation is going to be 84.5 and our ending value is going to be 84.5. 169 minus 84.5 is 84.5. 84.5 beginning value times 50% is 42,250. Net book value at the end of the year is 42,250. In 2020, we're going to take our 42,250 times 50%, but the problem is that'll take us to a net book value that is less than the salvage value, and we can't have that. So we know that our year-end value needs to be no less than 34,000. So we're going to force that depreciation of 8,250, and then in year 4, we're not going to depreciate anything. Okay. So 135,000 total of depreciation. Moving on to exercise 8-9. So Tory Enterprises pays $238,400 for equipment that'll last 5 years, has a salvage value of $43,600. By using the equipment in its operation for 5 years, the company expects to earn $88,500 annually after deducting all of its expenses except depreciation. So prepare a table showing income before depreciation, depreciation expense, net pre-tax income for each year, and the total for the 5-year period, assuming straight line is used. So here we go. So let's figure out what our depreciation is. So we've got $238,400 of cost less a $43,600 salvage value divided by 5 years. So $238,400 minus $43,600 is a net of $194,800 divided by 5 years. So we have $38,960 per year. So they tell us the company expects to earn $88,500 annually after deducting all expenses except for depreciation. So you have income before depreciation. In all 5 years, same number. Depreciation expense is going to be the same number in all 5 years, right? So we have net pre-tax income of $88,500 minus $38,960, the same for all 5 years. Okay? Easy peasy. All right, your turn. Same problem, different numbers. You know the drill. All right, so cost minus salvage divided by estimated useful life. And this one is $236,700 divided by salvage value of $46,700 divided by 5 years. So you have a net $190,000 divided by 5 years. $38,000 in depreciation per year. Prepare a table showing income before depreciation, depreciation expense, and net pre-tax income. Well, income before depreciation is the same for all 5 years. Our depreciation expense is the same for all 5 years. 81.9 minus 38 is 43.9. So we have total income over the 5-year period of 409,500. Total depreciation of 190,000. Total net pre-tax income is 219,500. All right, exercise 810. Torii Enterprises pays $238,400 for equipment that will last 5 years. Salvage value of $43,600. Expects to earn $88,500 annually. Now they want us to prepare the table, but this time using the double declining balance method. Double declining balance, 200% divided by 5 years times your beginning of year book value. So your depreciation expense is 40% times your beginning of year book value. So year 1, we have $238,400 beginning of the year book value times 40%. Annual depreciation of $95,360. $238,400 minus $95,360 is $143,040. That becomes our beginning balance the next year times 40%. It's $57,216. $143,040 minus $57,216 is $85,824. $85,824 becomes your beginning book value times 40%. Annual depreciation of $34,330 and a net book value of $51,494. In year 4, our 40% of our $51,494 takes our net book value to below what our salvage value should be, which is $43,600. So we're going to force it, right? And we have no depreciation in year 5. So there's our annual depreciation by year. So now if we take that, so they told us 88,500 is their income before depreciation. We put all of our depreciation expense in there for each of the years and compute the net pre-tax income. We've got a net loss in year 1, but then we have income in all of the subsequent years. Okay. All right. So using the double declining balance method, it take a few minutes and compute the required information, and then when you're finished, we can resume and go through the answers. All right, double declining balance method, 200% divided by 5 years. 40% per year. Beginning book value to start is our cost, $236,700 times 40%. Annual depreciation of $94,680. Net book value, $142,020. $142,020 times 40%, $56,808. $142,020 minus $56,808 is $85,212. Moving on to year 3. Year 4, I think we get stuck, as in we can't take our full 40% because we will be below our salvage value. So we're going to plug our annual depreciation to be whatever it is that we need to get from this 51,127 to this 46,700 salvage value. And so 51,127 minus 46,700 is 4,427. And we'll have no depreciation in year 5. So if we take those depreciation numbers and we put them in the table, we end up with a pre-tax loss in year 1 of $12,780, income in all of the rest of the years for a total of $219,500 over the 5-year period. Okay. Exercise 811. On April 1st, Cyclone Backhoe Company purchased a trencher for $280,000. It's expected to last 5 years and have a salvage value of $40,000. Compute depreciation expense for 17 and 18 using the straight line method. Well, that's easy peasy, right? Cost minus salvage divided by useful life. So we have 240 is our net between our purchase price and our salvage, divided by 5 years. Depreciation expense per year of $48,000. All right, so annual depreciation for 17, 48,000. Annual depreciation for 18. Oh, I almost goofed and did what you guys told me, what I keep telling you guys to pay attention to. So, hey, don't do what I just about did. Oops. See, they bought it on April 1st of 17. Do you see that? Yeah, so in 17, here's your problem. In 17, we can only record 9/12 of our year worth of depreciation, right? So 48,000 times 9/12, it's 36,000. In 18, it's a full year. So you have 48,000 times 12/12, right? So those dates are key, okay? All right. Here is the same problem, different numbers. Why don't you take a few minutes? Don't make the same mistake I almost did in the last slide. Pay attention to your dates and compute the depreciation expense for 17 and 18. All right, so straight line depreciation, cost minus salvage, 250,000 minus 25, divided by 5. It's 45,000 per year. 17, annual depreciation, 45,000 times 9/12. They bought it on April 1st. It's depreciation expense of 33,750. But in year 18, it's the whole year, right? So you take all 45. All right, so hopefully you found that one to be easy and you didn't get hung up on the date. Let's move on to the next. Exercise 812. On April 1st, Cyclone's Backhoe Company purchased a trencher for $280,000. It's expected to have 5-year life and a salvage value of $40,000. Compute the depreciation for both years using double declining balance. So 200,000 or 200% rather divided by 5 years times beginning of the year book value. 40% times book value. So in 17, our beginning of the year book value was 280,000, right? Our rate's 40%. Our fraction of the year, 9/12, right? So that's $84,000. 280 times 40% times 9 divided by 12. Which means our year-end value is 280 minus 84, 196. So in year 2, we have 196,000 times 40% times 12/12, 78,400. Net book value of 117,600. Okay. All right, same problem, different numbers. Why don't you give it a try and then resume the recording when you're done and we can go through the answers. Alrighty, so double declining balance depreciation, 200% divided by 5 years, 40% per year. Beginning book value is 250 times our depreciation rate of 40% times our fraction of the year. We bought it in April, right? April 1st, 17. So that's 9/12. Depreciation expense of 75,000. So we've got 250,000 minus 75,000. It's net book value of $175,000. Then in 18, we've got a beginning book value of $175,000 times 40% times 12/12. Depreciation expense is $70,000. So we have a year-end net book value of 105. Okay, hopefully you did well on that one. Let's move on to the next. All right, exercise 813. Apex Fitness Club uses straight line depreciation for a machine costing $23,860. Estimated 4-year life, $2,400 salvage value. At the beginning of the third year, Apex determines the machine has 3 more years remaining, after which it'll have an estimated $2,000 salvage value. So, compute the machine's value at the end of the second year and the amount of depreciation for each of the 3 final years, given the revised estimates. So, we've got our original straight line depreciation, which is cost minus salvage. So 23,860 minus 2,400 divided by 4. 5,365 per year of depreciation expense. So they tell us at the beginning of the third year they're re-estimating. So we would have 2 years of depreciation down. So we have year 1 book value and our depreciation, and then we have year 2 book value and our depreciation. So our book value at the time that they re-estimate is $13,130. So we take our $13,130 minus our revised salvage, which is $2,000, divided by how many years remaining? 3 more years. So that's a depreciation expense of $3,710 per year for each of the remaining years. So we start with our beginning book value minus our depreciation equals end. So we're recording our $3,710 in each of the remaining years. So we have a total depreciation of $21,860, which would leave a value of 2. All right, so same problem, different numbers. Why don't you take a few minutes and see if you can't figure this one out, and then we can go through the answers. All right, so straight line depreciation originally was our cost of 30 minus our salvage of 2 divided by 4 years, which is 7,000 per year. So we had 7,000, we started with 30, we recorded 7,000 of depreciation in year 1, recorded 7,000 in year 2, so we have a net book value at the end of 2 years of $16,000. So $16,000 minus our new salvage, which is $1,300, divided by 3 remaining years, 14,700, divided by 3 years, 4,900 per year. So we're going to record 4,900 in each of the last 3 years. We'll get to a net book value of $1,300, which is equal to the salvage. That's what we want. And we've recorded 28,700 total of depreciation over the 5 years. Okay, is that what you guys got? Hopefully you got that correct. Let's move on to the next. All right, exercise 814. All right, Oki Company pays $264,000 for equipment expected to last 4 years. Salvage value of $29,000. Prepare the journal entries for the following costs. Okay, so let's look at them individually on the next slide. So during the second year, the equipment's life, $22,000 cash is paid for a new component expected to increase the productivity of the equipment. So that's going to extend the life. So we're going to record that to the asset account equipment. It's a betterment. $22,000 debit equipment, credit cash. Okay. During year 2, or during the third year, $6,250 is paid for normal repairs to keep it in good working order. Not a betterment, right? So it just goes to repair expense, debit, credit cash. Then in the third or fourth year, $14,870 is paid for repairs expected to increase the useful life from 4 to 5 years. So we're going to record that to equipment. Debit equipment, credit cash. Okay. All right, same example, but different numbers. Why don't you take a few minutes, record the journal entries, and when you're finished, resume the recording and we can go through the answers. All right, during the second year, 30,000 cash paid for a new component, expected to increase the productivity. That gets recorded to equipment. It's a betterment. Debit equipment, credit cash. During the third year, $5,000 cash is paid for normal repairs necessary to keep the equipment in good working order. It's a repair expense. Debit repairs, credit cash. During the fourth year, $18,000 is paid for repairs expected to increase the useful life of the equipment from 4 to 5 years. That's a betterment. Gets recorded to equipment, debit equipment, credit, cash. Okay, hopefully you got all those correct. Exercise 815. Martinez Company owns a building that appears on its prior year balance sheet at its original cost less its accumulated depreciation. It's depreciated on a straight line basis over 20 years with no salvage. During the first week of January in the current calendar year, major structural repairs are completed for a $68,350 cost. The repairs extend its life by 5 years beyond the original 20 estimated. Determine the building's age as of the prior year-end balance sheet date. So let's figure this out. So we've got $572,000 minus 0 salvage, and it was an original 20-year life. So that means our depreciation expense is $28,600 per year. And they tell us our accumulated is $429,000. So we take $429,000 divided by the annual depreciation. That means it's beginning its 16th year in that January that they're referring to. So the building's 15 years old. So the entry to record the cost of the structural repairs. Debit to building, credit to cash. So now we have to compute what the book value is immediately after the repairs are recorded. So we got $572,000 plus $68,350. So we have a total cost of $640,350 less our accumulated depreciation. So our book value after our repairs is $211,350. Okay. Then we have to prepare the entry to record the current year's depreciation. So we've got our new book value of $211,350, no salvage, and they tell us it has 5 years beyond the original 20. Well, we got 5 years left of the original 20 plus the new 5 years, so that's 10 years. So we have $21,135 of depreciation expense per year. We're going to record our depreciation for the current year, debit depreciation expense, credit accumulated depreciation. All right, so same problem, different numbers. Why don't you give it a try, and when you're finished, we can resume and go through the answers. So the building's age at the prior balance sheet date, let's figure it out. Cost minus salvage divided by useful life, 671 minus 0 salvage divided by 20 years. $33,550 per year. They tell us the accumulated depreciation is $503,250. You divide that by the annual depreciation. The building is 15 years old. So if we prepare the entry to record the cost of the structural repairs, debit building for the $80,376, they tell us how much it costs. Credit cash. Then determine the book value immediately after the repairs are recorded. So we have 671 plus our repairs, 751,376. Less our accumulated depreciation is our new net book value, right? So the current year depreciation is going to take our new net book value minus salvage, which is 248,126 divided by 10 remaining years, 24,813 per year, right? So we're going to debit depreciation expense and we're going to credit accumulated depreciation. All right, exercise 816. Diaz Company owns a milling machine that costs $250,000 and has accumulated depreciation of $182,000. Prepare the entry to record disposal of the milling machine on January 3rd under each of the following independent situations. All right, so there's our T accounts. The machine needed extensive repairs, wasn't worth repairing. Diaz disposed of the machine, receiving nothing in return. So we have a book value of $68,000. So on January 3rd, we would remove our milling machine, and we do that with a credit. $250,000, right? You have a debit over here on the left side of your T account. So we need a credit on the right side to take it to zero. Remove our accumulated depreciation for $182,000. So we have a loss on disposal of $68,000. In scenario 2, Diaz sold it for $35,000 cash. So we're gonna remove our milling machine, credit $250,000, remove our accumulated, debit $182,000, receive our cash, increase that with a debit of $35,000. Since the selling price of $35,000 is less than the book value, we have a loss. So we have a loss on milling machine sale of $33,000. Okay. Well, what if Diaz sold the machine for $68,000 cash? Accumulated depreciation on our milling machine, we debit $182,000. Credit our milling machine for $250,000. We have cash for $68,000. So we don't have any gain or loss because we sold it for the net book value, right? All right, and then our last scenario, Diaz sold the machine for $80,000 cash. So we've got a credit to milling machine for $250,000, debit to accumulated depreciation for $182,000, and cash for $80,000. Since the selling price of $80,000 is greater than the $68,000 book value, there's a gain. So we have gain on sale of milling machine for $12,000. All right, so Diaz Company owns a milling machine that costs $126,300, accumulated depreciation of $94,200. And they're asking you to prepare all of the same entries that we just went through on the previous examples. So in the first situation, they just disposed of it and they didn't get anything in return. So take a minute, record that entry. When you're done, resume the recording and we'll go through it. All right, so we have milling machine of $126,300 debit, accumulated depreciation of $94,200 debit, book value of $32,100. So our journal entry to get rid of the machine, we need to credit the milling machine asset to remove it from our books for $126,300. Debit accumulated depreciation for $94,200. We have a loss on disposal equal to our net book value, $32,100. All right, why don't you try this one? Diaz sold the machine for $16,200 cash. So take a minute, record that journal entry, and when you're done, resume the recording, and we'll go through it. All right, so Diaz sold the machine for $16,200 cash. Remove our machine from our books, we do that with a credit. Remove the accumulation, we do that with a debit. Record our cash of $16,200. Our selling price of $16,200 is less than the book value, so we're going to have a loss on disposal, $15,900. How'd you do? All right, so part 3, Diaz sold the machine for $32,100. What's the entry? Remove our milling machine, credit. Remove our accumulation, our accumulated depreciation, debit. We sold it exactly equal to our book value, right? So we have cash of 32.1. We don't have any gain or loss because they sold it for exactly equal to the net book value. All right, the last one. Diaz sold the machine for $40,200. Why don't you take a minute, record that entry, and when you're done, resume the recording, and we will go through it. All right, so milling machine, we'll remove it from our books with a credit. Accumulated depreciation, we'll remove it from our books with a debit. Cash of $40,200. And because the selling price is greater than the net book value, we've got a gain on sale of $8,100. Okay. All right, exercise 817. Rah-Rah Company. Raya. These names, they're killing me. Raya Company purchases and installs a machine on January 1st, 18 at $105,000. Straight line depreciation is taken each of the 4 years, assuming a 7-year life and no salvage. It's disposed on July 1st, 2022 during its 5th year of service. So there's our T accounts. Our balance and accumulated depreciation, if we take $15,000 per year times 4 years, that's $60,000. Okay. So prepare the entry to record the partial year's depreciation on July 1st, 2022. So we have 6 years of depreciation. If a full year is $15,000, half year is going to be $7,500, right? So depreciation expense, debit $7,500, and accumulated depreciation credit for $7,500. So if we post that to our T account, we now have accumulated depreciation of $67,500. Value is going to be, our net book value is going to be $37,500. So when we sold the machine for $45,500, we're going to get rid of our machine, $105 credit, get rid of our accumulated depreciation for $67,500. We received cash for $45,500. So our cash was greater than our net book value because our net book value was $37,500 on July 1st. So we have a gain on sale equal to $8,000. So an insurance settlement of $25,000 is received on the machine due to a total destruction in a fire. So we're going to remove our machine for $105. We're going to remove our accumulated depreciation for $67,500. We're going to record cash from the settlement that we got from the insurance company. And then we have loss from fire, the difference between the cash settlement and what our book value was. Okay? All right, same problem. Why don't you take a few minutes, record the journal entry for the partial year depreciation. Then when you're finished, resume the recording and we will go through it. All right, so our journal entry for July 1st, we have $15,000 per year of depreciation. So half year is going to be $7,500. Debit depreciation expense, credit accumulated depreciation. So now we've got $67,500 in accumulated depreciation. So when they sell the machine for $40,000 cash, we're going to record our cash of $40,000. We're going to remove our accumulated depreciation with a debit of $67,500. Remove our machinery for $105 with a credit. We're going to have a gain on sale equal to $2,500 because the cash they received is greater than the net book value. Then in scenario 2, an insurance settlement of $36,000 is received to the machine's total destruction in a fire. So why don't you take a minute, give that journal entry a try, and when you're done, resume the recording and we will go through the answer. All right, so we'll receive $36,000 cash from the insurance company. We'll remove our accumulated depreciation with a debit of $67,500. We'll remove our machinery with a credit of $105,000, and we'll record a loss from fire for the difference. of $1,500. Okay. All right. Exercise 818. On April 2nd, 18, Montana Mining Company pays $3,721,000 for an ore deposit containing 1,525 tons of ore. They install the machinery in the mine, costing $213,500, with an estimated 7-year life and no salvage. The machinery will be abandoned once the ore is completely mined. Montana begins mining on May 1st, 18, and mines and sells 166,200 tons of ore during the remaining 8 months of 18. Prepare the journal entries to record both the ore deposit depletion and the mining machinery depreciation. So, cost minus salvage divided by the units. So we have $3,721,000 worth of cost minus 0 salvage divided by the number of tons they can get out of it. $2.44 per ton. So we have depletion expense of $2.44 per ton times 166,200 tons that they mined during the remaining months of 18. So we're going to have depletion expense of $405,528 in 18. So we're going to record depletion expense mineral deposit debit, accumulated depletion mineral deposit credit. Then our depreciation expense, cost minus salvage, divided by units of capacity. The reason why we're using units of capacity and not the years is because the mining machinery depreciation should be in proportion to the mine's depletion. So we're going to use units of capacity to do that. So we're going to take $213,500, the cost of the machinery, minus 0 salvage, divided by the 1.525 million tons, 14 cents per ton. So they depleted 166,200 tons in 18 times 14 cents of depreciation on the machinery to do it is depreciation expense of $23,268 and accumulated depreciation of $23,268. All right, why don't you take a stab at this one? Same problem, different numbers. When you're finished, resume the recording and we will go through the answers. All right, so our depletion expense, cost minus salvage divided by units of capacity, 3,614,250 minus 0, divided by 1,525 tons, 237 per ton. Depletion expense is 237 per ton times 185,400 tons in total, for a total depletion expense of 439,398 in 18. So we're going to record depletion expense for the mineral deposit, and we're going to record accumulated depletion for the mineral deposit. Then we have to compute our depreciation expense. They tell us it should be proportionate to the mine's depletion, so that means units of production method, basically. Cost minus salvage divided by total units. 213,500 minus 0 divided by 1.525 tons. 14 cents per ton. 14 cents per ton times 185,400 tons. It's 25,956 debit depreciation expense and credit accumulated depreciation. Okay? All right, exercise 819. Milano Gallery purchases a copyright on an oil painting for $418,000 on January 1st of 18. Copyright legally protects its owners for 10 or more years. Company plans to market and sell prints of the original for 11 years. Prepare the entries. All right, so we're going to record our copyright purchase of $418, debit and credit cash for $418,000. Now we have to compute our amortization expense. Cost minus remaining legal life, $418,000 divided by 10 years. It's $41,800 per year. So we're going to record amortization expense, debit of $41,800, and credit accumulated amortization, $41,800. All right, why don't you take a minute and work through the same problem, different numbers, and when you're done, you know the drill. We will go through it. All right, so this time Milano Gallery bought a copyright for $485,000. So we're going to debit copyright asset, $485,000, credit cash, $485,000. Computer amortization expense, cost minus legal life, $485,000 divided by 11 years, $44,091 per year. Amortization expense, debit, $44,091, credit accumulated amortization for $44,091. All right, exercise 820. All right, on January 1st of 18, Robinson Company purchased Franklin Company at a price of $2,500,000. The fair market value of the net assets was 1.8. So when that happens, you have what we call goodwill. So what's the amount of the goodwill that Robinson records at the purchase date? It's the purchase price less the fair market value of the net assets. So 2.5 million less 1.8 million. They record $700,000 at the purchase date. Now goodwill is not amortized, so instead they must test the value of the goodwill each year. And if the value is impaired, it must be written down. Goodwill is only recorded when it's purchased. It is not recorded by the company that creates it. Okay? All right, so why don't you take a stab here and calculate what the goodwill is? When you're done, resume the recording and we'll go through it. All right, so what is the amount of the goodwill that Robinson records at the purchase date? 3.84 million minus 2.7 million, 1.14 million. Okay. All right, exercise 820. The following information is from the annual financial statements of Loke Company. Calculate the asset turnover for 2018 and 2017. Asset turnover is net sales divided by average total assets. So in 2017, you have net sales of 5.856480 divided by 1.8 million total year-end assets plus the prior year-end, which is also the beginning of the current year, plus 1.686 divided by 2 is your average total assets. So they have total asset turnover of 3.36 times. For 18, it's your 8.679 million divided by 1.982 plus 1.8 divided by 2. So you have asset turnover of 4.59 times in 2018. All right, why don't you guys take a stab at it? And when you're done, resume the recording and we'll go through the answers. All right, net sales divided by average total assets for 17, you should have come up with 2.81 times. And for 18, you should have come up with 4.09 times. Okay? All right, so that concludes Chapter 8 exercises. As always, if you have any questions, please don't hesitate to reach out. Hopefully you'll find all of this information to be helpful in successfully completing all of the assignments for Chapter 8. Take care, guys.